Google is doubling its infrastructure budget to $180 billion this year. The CEO said last quarter it still will not be enough. I went back through 3 years of Alphabet earnings calls to find where this story actually starts. It does not start with AI. It starts with a $900 million check written to Elon Musk in 2015, now worth $122 billion on paper. And the same bet is about to determine whether Google can keep growing. Some of you already know Google Cloud is growing fast. You have probably heard that data centers are the next big thing for this company. But knowing the direction is not the same as knowing the scale. And once you see the actual numbers, the story looks different. In July 2018, Google announced a cable, not a fiber optic line running down a city street, an undersea cable, 10,500 kilometers long, running from Los Angeles to Chile. It was called Curie, named after Marie Curie. This was not a partnership with a telecom company. Google did not share ownership. It owned the whole thing. Jen Stowell, Google's head of global infrastructure negotiations, explained the decision publicly. She said Google needed to control the capacity, quality, latency, routing, technology, and scalability of its own network. No middleman, no shared access, complete ownership. It was the first time in history that a non-telecom company had privately funded and owned an intercontinental submarine cable. That was 2018. That was not the start. Google had been building quietly since 2014. The Curie cable was cable number 4. By the time you are watching this video, Google owns more than 30 submarine cable systems globally. The total length of its directly owned cables is over 100,000 kilometers. That is enough to wrap the Earth 2.5 times. And this is just one part of what you own when you hold Google. Now the data centers those cables connect to. In 2020, Google's data centers consume 14.4 million megawatt hours of electricity. In 2024, that number was 30.8 million megawatt hours, more than double in 4 years. To put that in human terms, 30.8 million megawatt hours is roughly the amount of electricity used by the entire country of Ireland in a year. Google burns through that much power every single year across its data centers, and that number is rising every quarter. The capital spending to support all of this, under $30 billion a year in 2020, $52 billion in 2024, $91 billion in 2025, $180 billion guided for 2026. Some of you are already forming the objection. That is an enormous amount of money. Can Google actually earn it back? And in how long? That reaction is fair. But consider what Sundar Pichai said in July 2024 when analysts pushed him on exactly that question during Alphabet's Q2 earnings call. The risk of underinvesting is dramatically greater than the risk of over-investing for us here. He is not saying that blindly. He is saying it because the demand data is behind it. I will show you those numbers in a moment. But before I do, I need to drop one figure. A single gigawatt of orbital compute, meaning AI computers running in space, costs approximately $42.4 billion to build today. That is roughly 3 times the cost of the same computing capacity built on the ground. Google is building it anyway. Hold that, we are coming back to it. The decisions being made right now about where computing power gets built are going to determine what Google looks like in 2035. Most investors are not tracking this yet. On April 29, 2026, Sundar Pichai was on Alphabet's Q1 earnings call. Google Cloud had just posted $20 billion in revenue for the quarter. Growth rate 63% year over year, one of the fastest of any major cloud provider on earth. An analyst asked how the quarter went. Pichai said this: "We are compute constrained in the near term. Our cloud revenue would have been higher if we were able to meet the demand." Read that sentence again. The CEO of one of the most valuable companies on earth, a company that spent $35.7 billion on infrastructure in that single quarter, said the business would have been bigger if they could only build fast enough. That is the real story underneath the headline. Google does not have a technology problem. It does not have a competition problem. It does not have a demand problem. It has a power problem. Here is how this works. Say I open Daniel's Burger Shop. Best burgers in town. Best staff, best location. But if the gas line coming into my kitchen can only supply fuel for 10 burners, I cannot run 40. It does not matter how good everything else is. Google's AI data centers are Daniel's Burger Shop. The power grid is the gas line. A single large AI training cluster, the kind Google needs to run its Gemini models, requires gigawatts of continuous power. For reference, 1 gigawatt powers roughly 750,000 average American homes simultaneously. Google needs multiple gigawatt scale power supplies, and it needs them fast. This is where the ground fails. In the United States, connecting a new large-scale data center to the power grid is not a matter of months. In many markets, the timeline runs 5 to 7 years. Utility negotiations, environmental assessments, regulatory permits, community approvals, physical grid infrastructure that has to be built before the data center can even turn on. Google's data center energy consumption doubled in 4 years. Its capex is doubling year over year. The grid cannot be forced to move faster than its permitting processes allow. The result? Google has $460 billion in cloud orders sitting in its backlog. Contracted demand, real customers, real commitments, real money already agreed to. And it cannot build fast enough to fulfill all of it. $460 billion. That is larger than the annual GDP of Thailand. That is demand Google has already won, not demand it is still chasing. Google's cloud revenue would have been higher last quarter. The constraint is not the product, it is the planet. If this breakdown is useful, hit like and subscribe. I go 3 layers deep every week. If the ground cannot provide enough power fast enough, where do you go? Google's answer is the sun. Not solar panels on a rooftop, not a solar farm in the desert that still need a grid connection and a permitting process. Solar panels in space. In low Earth orbit, approximately 650 kilometers above the surface, solar panels receive 5 to 8 times more energy from the sun than they do on the ground. No atmosphere blocking the light. No weather. No night cycle if the satellite is positioned correctly. No grid, no permits, no 7-year wait. Google's project is called Project Suncatcher. Sundar Pichai announced it in late 2025. The plan, clusters of 81 satellites, each cluster spanning roughly 1 kilometer, running Google's own custom TPU chips. The same chips that power Google's AI models on the ground, now running in orbit, powered by solar, connected to Earth via laser links. First prototype satellites are scheduled to launch with Planet Labs by early 2027. And on May 12, 2026, the Wall Street Journal reported that Google is in active talks with SpaceX to provide the rocket launches. This is not a signed deal. It is talks. Google is also speaking with other launch providers. But SpaceX is the dominant name on the list. And here's why that matters specifically if you are holding Google. Go back to January 2015. Google wrote a $900 million check to Elon Musk's company. It bought approximately 7.4% of SpaceX at the $12 billion valuation. In the same month, SpaceX publicly announced Starlink for the first time. Most people who covered that investment in 2015 called it a financial bet on a rocket company. That is not what it was, or at least it was not only that. Google needed a partner who could eventually make launch costs cheap enough that putting compute into orbit would make economic sense. In 2015, Elon Musk was the only person in the world seriously working on that specific problem. Imagine you are inside Google in January 2015. You are running the most advanced private internet on Earth. You have already laid 4 undersea cables across the ocean floor with more planned. And you can see in the compute demand data that the power constraint is coming. The AI workloads are building. The grid is not going to keep up. You have a chance to put $900 million into one company working on cheap access to space. What do you do with that? Google wrote the check. Fast forward to 2026. Google's 6.11% stake in SpaceX, confirmed via an Alaska state regulatory filing, is now worth approximately $122 billion on paper. For context, that is more than what Google Cloud generated in revenue across all of 2022. And in Q1 2026, roughly 25% of Alphabet's entire net income came from that single investment. Not search, not YouTube, not cloud. A bet made in 2015 that most Google investors have never looked at as a portfolio asset. Now here's where some of you are going to push back. You might be looking at the 2035 break-even timeline for orbital data centers and thinking, that is too far away to matter for a position I'm holding today. That reaction is reasonable. A decade is a long time. But the infrastructure that makes 2035 possible is being built right now. Starship is still in development, but the next test flight is weeks away. Launch economics compress with every successful flight. The prototype satellites go up in 2027. The cost crossover does not sit at a fixed point. It moves earlier every time the launch cadence accelerates. The question is not whether this plays out in 2035. The question is whether Google is already pricing this optionality in, or whether the market is still reading it as a search company with a cloud side project. Let me give you the financial pictures straight. 4 quarters ago, Google Cloud's operating margin was 9.4%. In Q1 2026, it was 32.9%. That is the fastest margin expansion of any major cloud business in the last 2 years. AWS, the company that invented cloud infrastructure as a product, now operates at a margin that is roughly at parity with what Google Cloud just posted. For a long time, the bear case on Google was simple. Google Cloud was losing money. It was subsidizing a business that could not compete with AWS or Azure. That argument is gone. Cloud revenue, $20 billion in Q1 2026. Year-over-year growth, 63%. That is faster than Azure at 40% and AWS at 28% in the same quarter. Most investors look at Alphabet and see the advertising business. Advertising still drives about 75% of total revenue. That is a real concentration risk. But look at what is sitting next to it. A cloud business growing faster than AWS and Azure, now at comparable margins. A $460 billion backlog of contracted demand, and a $122 billion investment in a company that may determine how fast that backlog gets delivered. Most people have not connected all. I want to hear from you. If you are holding Google right now, is the infrastructure story part of your thesis? Or are you in it for something else entirely? Tell me in the comments. The answer matters because it changes which metrics you should be watching on the next earnings call. Before the close, there is one more asset sitting inside Alphabet that most Google holders have not fully run the numbers on. Waymo. On February 2nd, 2026, Waymo raised $16 billion at the $126 billion post-money valuation, the largest single fundraise in autonomous vehicle history. Waymo now covers 1,400 square miles across 11 US cities, a figure that expanded 27% on May 13, 2026. 20 million trips completed. Target 1 million trips per week by end of 2026. It sits inside Alphabet's other bets segment, valued at book on the balance sheet. Most Google investors have never done the math on what 126 billion asset means as a percentage of Alphabet's total market cap, and what it means for the stock if Waymo hits those trip targets. That is the next video. I'm going 3 layers deep on that one. 3 things I'm watching from here. 1. Google Cloud's next 2 quarterly reports. Pichai said demand exists and supply is the constraint. The $460 billion backlog either converts into recognized revenue or it does not. That number tells you whether the infrastructure spending is working on schedule. 2. Starship's development progress. Starship version 3 is scheduled to fly in the coming weeks. Google's Orbital data center economics require launch costs to eventually fall to $200 per kilogram. Every successful test flight moves that timeline. Watch the test results, not the headlines. 3. Alphabet's next disclosure on its SpaceX stake. The 6.11% figure came from an Alaska state regulatory filing. When Alphabet files its next annual report, look for any change in that position. If they are reducing it, that tells you something. If they are holding, that tells you something else. Google wrote a $900 million check to Elon Musk in January 2015. On April 29, 2026, Pichai said the cloud revenue would have been higher. The company that may determine how fast Google can fix is the one Google backed the same month it first heard the name Starlink. When the next earnings call drops and Pichai gives the cloud revenue number, ask yourself one question. Are you reading that number the way most investors view, or the way the infrastructure story eventually points? If this breakdown is useful, hit like and subscribe. I go 3 layers deep every week.